Your total returns, including interest, pre-tax returns are likely to be 10,000 rupees, 183 rupees, right? If you go for 3 months period, you're going to get interest here on 17th of August, you're going to get interest on 17th of September. Hi friends, if you want to invest your money for short duration, let's say 3 months, 6 months, 9 months or 12 months, this video is for you. Why? Because in this video, I'm going to explain to you corporate bonds. And the best part about corporate bonds is that nowadays you can invest in corporate bonds with a minimum amount as low as 1,000 rupees. Now, even if you have never invested in corporate bonds in your life so far, this 1,000 rupees minimum amount and the shorter duration of 3 months, 6 months allows you to trial out corporate bonds in your portfolio. Again, it is not a push from my side that you start investing about corporate bonds, but there is definitely a push from my side that you start learning about corporate bonds. Whether you invest or not, it is entirely up to you. But in this video, I'm going to talk about two very, very important points about corporate bonds. Number one is how to select a corporate bond that is absolutely fit for your individual needs. And also you need to understand what are the risks you are taking when you're investing in corporate bonds. And second point is, if you ever want to sell your corporate bonds before the maturity date, how to go about selling your corporate bond. If you don't know me, my name is Rahul Jain. I'm a full-time investor and a full-time content creator. If you're new to my channel, do not yet subscribe to this channel. Please watch this content for a few more minutes. And if you like the content because you're gaining some knowledge, then become a lifelong subscriber, because there is no point in subscribing to hundreds of YouTube channels and really not learning anything new. With that spirit, shall we get this video cracking? Let's go. So the first thing that I would like to cover is how to go about investing in corporate bonds for shorter duration like 3 months or 6 months. For this, I'm heading over to Vint Wealth, partners of this video. You can choose any other SEBI registered online bond platform that you personally like. I personally like Vint Wealth mainly because of two reasons. Number one, they are SEBI registered. And number two, all the NBFC bonds that they bring on this platform, Vint Wealth themselves invest 2% in that particular bond. And that gives me added confidence, because when they're bringing any bonds to the platform, they are doing a lot of due diligence themselves. But as I said, you can use any other SEBI registered online bond platform. So the first step here will be that you open your Demat account with Vint. The process is very, very straightforward, but towards the end of this video, I have created a short clip that you can watch and you can easily go and create your own Demat account. You will find the link in the description and in the pinned comment if you want to use my link. After opening your account, when you go to the dashboard, this is what you will see. First thing we are going to do is come down here and click on View All. We are going to see all the bonds listed there. These are all example bonds. Please do not take any of these as recommendations. My intent is to practically show you. That's why I'm showing you this list. In fact, I don't know when you're watching this video, your list might be entirely different. Now, the second thing we will do is we will sort these bonds out by tenure. So go here and click on tenure low to high. What you see here is that you will see, for example, first bond comes as it is having a maturity period of only 5 months. So you can invest in this particular bond for 5 months. Then you have 7 months, then you have 8 months. So these are the bonds that are called fixed maturity left bonds, because there is only a fixed maturity left. But if you go down, you will also see something very interesting here. These bonds, for example, this one here is showing you tenure as between 3 to 10 months, 3 to 11 months, and so on and so forth. Let's try and understand the difference between these two types of bonds. So if I go, first of all, let's say pick up anyone. So let me pick up Navi June 25, this bond. Click on it, and if you come down here, let's go down to other bond details here. So when you click on it, you will see a pop-up coming, and when you come down here, you will note allotment date and maturity date. What does allotment date means? It is 22nd July 2024 in this example, meaning that first time these bonds were allotted, it was the date which is 22nd July 2024, and they were allotted with a maturity date of 22nd January 2026, meaning these bonds were issued for 18 months. Today is 3rd of July 2025 when I'm recording this video. If I were to invest in this particular bond today, for me, maturity will be what? It will be up to 22nd January 2026. For me, the maturity period now will remain around 7 months. Now, just in case you're wondering, how is that I am able to get this bond on 3rd of July 2025? There is a concept that you need to understand, which is called bond trading. Very much similar to how stocks are traded on exchange, you can go buy and sell corporate bonds as well. Why? Because corporate bonds are also stored in the Demat account. When you opened your Vint Wealth account, you are actually opening your Demat account. So in this example, let's say I got this bond allotted from Navi, directly from Navi on 22nd of July 2024, and I held this bond. I started getting my monthly interest every month. Come 3rd of July 2025, and I decide that, you know what, I want my principal to be given back to me. What I can do is I can go and sell this bond in the market. Let's say you are the new buyer and you are interested to invest your money because you have spare money. You can buy this bond. So what will happen is I am the seller, you are the buyer. Very similar to how stock market works. I get my principal amount back once I sell it to you. And from that point onwards, you start to get monthly payments and you can hold this bond up until 22nd Jan 2026. Or if you want to exit it, you can exit it. It is your choice. However, when you go to sell a corporate bond, you also have to look at liquidity, meaning number of buyers that are ready to buy that bond or not. And sometimes because of that, either the bond price at which you are going to sell it might be at premium or might be at discount. Now let's go back to the main screen and let's try to see the other types of bonds which are having the maturity left as the range 3 to 9 months, 3 to 11 months, whatever. So if you come down here and let's go and pick up one of them. Again, let's go and pick Navi 2nd of April 2025 and click on it. Here now you see, for example, 3 months, 6 months, 11 months. Now, if you come down here and just click on view more, what you will see is that there are 3 options that this platform is giving you, that you can invest in this particular bond for 3 months here. Your yield to maturity, which is your net returns, will be 9.5%. This is annually. And if you want to invest for 6 months, that is going to be 10%. And if you invest for 11 months, that is when the bond actually matures. Your YTM, which is yield to maturity, net returns, overall returns, annual basis are likely to be 11%. And when you come down, you will see the complete breakdown of the interest. For example, let's say I want to go for 3 months because we are interested in the short duration. What you will note here is the schedule here has been automatically updated. So this is telling you that if you invest in this bond, you will have to pay for 1 unit 9,000 rupees, 959 rupees, right? Your total returns, including interest, pre-tax returns are likely to be 10,000 rupees, 183 rupees, right? If you go for 3 months period, you're going to get interest here on 17th of August. You're going to get interest on 17th of September. Now, actually, this bond's maturity is 11 months away. But what Wind platform has done is it has made it very flexible, that if you only want to hold it for 3 months, what will happen is after 3 months, automatically a sell request will be placed on this particular bond that is in your demat account, and it will be sold off as soon as they find a buyer, right? So, and after that, on 1st of October, you get your complete principal back. This is the schedule that you are able to see here. Your total money that you will get back is 10,000 rupees, 183 rupees roughly. Now, if you come down here, what you will note is that here you will also note that what they're saying is the bond's maturity is 11 months. They're placing a sell order. It is not guaranteed here that they will be able to definitely find a buyer in the market. So therefore, if you're going with the bonds that are showing you a range, there is a possibility, there is a chance that you might not be able to find a buyer immediately after 3 months. Therefore, you have to understand this point very clearly. And if you're not comfortable with 3 to 9 months or 3 to 11 months range types of bonds, then it is better to stick with the first category that I showed you, where you get the fixed maturity. 5 months, 6 months, 7 months, whichever is your investment horizon. But please make sure these 2 points are very clear to you and you can decide which one you are going ahead with. But more importantly for me, what this flexibility is doing is it is allowing you to trial out corporate bonds in your portfolio, because you could start with as low as 1,000 rupees and you could start with as minimum duration to avoid any risks. Because if you're a beginner, then you might be worried about a lot of things, right? So you might want to start with 3 months period and see how it goes. See what your experience is. See the entire experience of buying the bond, exiting the bond, getting the interest paid in your account, and then slowly you can start to build your corporate bond portfolio if you enjoy this particular asset class. Now you may say that, Rahul, this sounds all great, but what happens if these online bond platforms shut down? What is the risk around it? Here is what you need to know. If you're going ahead with any SEBI registered bond platform, please understand that when you are buying a bond from that platform, your bond is getting stored in the demat account, not on the online bond platform. This is very important. Why? Because if the online bond platform is shut down, you are still the owner of that bond. Number one. Number two, you can go and access that particular bond via exchange. For example, you can log into NSDL website. Here you will see all your bonds. You can click on any of these individual holdings. You can view these holdings. Since you are the owner of these bonds, you are likely to continue to get your interest payments on time. You're likely to get your principal back on time based on your bond terms. Online bond platforms' job here is limited in terms of buying and selling the bond, but actually you are the owner. The bonds are stored in the demat account. Therefore, if the online bond platform shuts down, you still remain the owner of the bond. Actually, more than the online bond platform going bust type of a risk, you need to focus on the key risk, which is the default risk of the bond itself. Meaning that, let's say you buy a bond of a XYZ company. What happens if that XYZ company goes bust? It goes bankrupt. That is the main risk, and that is called the default risk in bonds terminologies. So typically what happens is when a company goes bust, what happens is that their assets are liquidated. They are sold to somebody, and whatever money is recovered by selling those assets, that money is distributed to various stakeholders, and bondholders is one of them. The bonds that we are talking about in this context are called secured corporate bonds. And these secured corporate bonds, as the name suggests, they are secured. The preference is given to the secured bondholders because these bonds are secured by the company assets. So whatever money is recovered, it is distributed to the corporate bondholders as well. And you might get some money. There might be partial recovery. There might be full recovery. The process of recovery may take time. Hence, you need to understand that if you're investing in bonds, corporate bonds, the secured corporate bonds come with a default risk. Now the natural question will be, Rahul, how do we know which bonds are more riskier, which bonds are less riskier? Then comes the concept of credit rating. So there are rating agencies, for example, CRISIL, India Rating, so on and so forth. And these rating agencies look at that company's balance sheet, P&L account, various financial aspects, many things, and they give them a rating. For example, here, if you look at these ratings here, AAA, AA, A, BBB, you might have heard about these ratings. AAA is considered the most safest, then comes AA, then A, BBB, and so on and so forth. What you note here is the interest rate, which is also called coupon rate, depends on the rating. If the bond is rated highly, let us say AAA, the coupon rate or interest rate is lower here, 7 to 8%, right? Now here, individual can make their own choices, right? What is their risk appetite? How much of risk they want to take versus the coupon rate that they're interested in. My personal choice, again, this is my personal choice. Your choice might be very, very different. My personal choice is A rating because I think it's a good combination between the interest rates as well as the default risk. So again, this is my choice. You can decide to differ with me. But more importantly, here is some mind-boggling data for you that if you look at the past historical data and if you look at these rated bonds like AAA, AA, what has been the default rate actually? Right? How much of risk are we actually talking about? So look at this study. This report was published by India Ratings and Research. All the bonds that India Ratings and Research had rated in the last 5 years here and in the last 10 years, they have compiled the default rate. CDR means cumulative default rates. Very, very important data point for any corporate bond investor. What you note here is the two conclusions from this data. Number one is, if you look at the weighted average for last 5 years, for example, let us say BBB bond here, you see, and if you look at 1 year period, 0.8, 2.0, 2.9, these are the default rates in the last 5 years, depending on the time horizon you're taking, 1 year, 2 year, 3 years. But if you look at the weighted average for last 10 years, you will note that 10 years average is higher. 1.5 versus 0.8, 3.8 versus 2, 6 versus 2.9, meaning that in the last 5 years, bond default rates have come down slightly. If you look at the 10-year data, first 5 years might have been heavy default rate because what we clearly can see here is that last 5 years default rates have come down versus 10 years. That is point number one. And my personal assessment here is that in the last 5 years, if you look at Indian companies' balance sheets, they have become very, very strong. Lot of leverage or debt has gone out. They have become lighter. Therefore, it is entirely possible. It might be the reason because I analyze a lot of stocks and companies, and that is my personal assessment. I cannot really give you any data point on that. But coming back, more importantly, the point about what is the actual default rates. If you look at AAA rating, 0 is the default rates. They have not defaulted. AA, it's been between 0.1 to 0.2 depending on how long horizon you are looking at. If you look at A rating, between 0.2% to 2.5%, right? If you look at BBB, 0.8 to almost 6%, right? So you can accordingly make your risk profiles. You can accordingly decide which type of bond you want to go ahead with. I have presented this data to you in a totally unbiased manner. And if you like this analysis, request you to hit the like button. Let me know in the comments a simple thank you. It motivates me to bring such content for you at zero cost. Now let me quickly show you the point number 2, which is how to go about selling your bond on Vint Wealth platform if you got it from Vint. That is the only flow that I'm going to cover now. So simply when you go to your portfolio, you are going to see all these bonds listed there. What you will need to do is select the bond that you want to sell. And here you will be able to see all your history in terms of how much you invested, how much of interest you have been paid so far, so on and so forth. You simply click on proceed to sell. You will now see the selling price that is coming up. You can also see the breakdown of this in terms of what is your effective ITM. You can see what is the sell amount that you're actually getting at the time of selling this bond. And you can also see the total earnings breakdown here in terms of what is the total repaid amount, things like that. And once you're happy with that review, you can simply proceed to sell, click on the sell button, and your sell order is now placed. You have to just wait. So once the sell order is placed, you will then get further updates on your WhatsApp in terms of when the sale is likely to complete. Although I have covered the sell part as well on Vint, my view is that when you're investing in bonds, try to invest in those bonds that you want to hold it until maturity, whether it's 5 months, 6 months, 12 months, 2 years, 3 years, whatever is the duration, so that you don't get into selling it and things like that. Sometimes that might be very clumsy in terms of selling the bonds. But again, if you want to get your money back early because of emergency need or whatever has happened, that option is still out there. You can go and sell your bonds. Let me now walk you through Vint Wealth account opening process. Simply go to your mobile and download Vint Wealth app. Then you enter your mobile number that is linked with the Aadhaar card. You will get an OTP. You do the authentication, and after that, you will have to set up your PIN. Once you've set up your PIN, then you start your KYC process. First, you will have to enter your basic information, for example, your name, etc. After that, you will have to do bank verification. Now, this is the bank account where your interest and capital will come back. So make sure you add appropriate bank account details. After that, you will have to verify your signatures. Once it is done, you take a selfie. And final step will be the DigiLocker, verify your Aadhaar and PAN card details. Very, very straightforward process. And after this last verification, you are ready to invest in bonds. So in this video, I've given you a lot of details around how to go about investing in corporate bonds for the shorter duration. I hope you liked this video. If you did, share it with your friends. Like this video. Let me know in the comments a simple thank you, and subscribe to my channel because I'm going to bring a lot of quality content for you at zero cost. With that, I hope to see you in my next video. Until then, keep rocking.
Investments in debt securities, municipal debt securities, securitized debt instruments are subject to risks, including delay and/or default in payment. Read all the offer-related documents carefully.